Crowdfunding, the process. The process of property crowdfunding can vary depending upon the provider, but generally follows similar paths. The process starts with an investor identifying a provider who they feel offers an opportunity that matches their goals. For example, some providers offer crowdfunding for commercial properties only, whereas others offer residential properties to invest in and then resell or invest in and keep. Once an investor has found an opportunity they want to be a part of, they must first register with the provider and join the crowd. Registration is usually broken down into 3 parts. 1. Personal information. Here, an investor must confirm their details, including full name, address, and date of birth. 2. Identification documents. All investors are required to provide photographic ID and proof of address documents. These will then be verified by the provider against national and international databases to ensure they are genuine and the investor is not disqualified. And 3. Self-certification. Due to the risks involved in crowdfunding, all investors are asked to confirm their previous experience with investing and their understanding of the risks involved. As part of the registration process, the provider must ensure they know your customer, KYC, and carry out anti-money laundering, AML checks, which are both prescribed by the Financial Conduct Authority, FCA, who oversee crowdfunding in the UK. Once an investor has registered and passed all relevant checks, they can often deposit funds by debit card or bank transfer to their online investment account. With funds in place, an investor is ready to invest. Most crowdfunding opportunities are structured using special purpose vehicles, SPVs, which include limited companies that have been incorporated to own and manage the investment property. This means that investors are investing in the company that owns the property and do so by buying shares. Shares are available from as little as £100 and are often advertised on a platform alongside similar opportunities. Each advert will provide the investor with more information about what they are investing in, the length of time the investment is for, and a breakdown of the total funds being raised. These often include insurance, renovation costs, and provisions funds for unknown expenses in the future. Pictures of the property will be provided as well as projections which give investors an idea about how the investment is expected to perform over a period of time and what type of return they can achieve. Once an investor is happy with the property they want to invest in, they can do so with the click of a button, which will automatically transfer their investment and register them as a shareholder and co-owner of the company. After an investment has been made, an investor can expect to receive some form of return on their investment, either during the investment term or at the end. The return they receive will all depend upon what type of investment they have chosen, but often an investor can expect to receive their share of monthly rental income the property generates after costs, which is paid directly into their online investment account. Most investors will hold their shares for the full investment term. However, some investors may want to sell their shares early and can often do this using a secondary market function provided for them by the crowdfund platform. This allows other investors to buy their shares and take over their ownership in the investment property. At the end of the investment term, the shareholders often vote on what to do with the property next. The 2 main choices are 1. To retain the property and continue to operate it as before, or 2. To sell the property, where investors will receive their share in any capital growth that has been achieved, along with the repayment of their original investment.